The move in Celsius stock over the last couple of months is one of those reminders that it's always really important to consider what the time frame is for investors and people that you're following when they're looking at a stock. Are they looking at the daily or weekly moves of a stock, scanner data, which has been moving Celsius over the last couple of weeks, or are they thinking about what a company is going to do long term? Now, I am a long-term investor. I have no idea what the weekly sales of Celsius are going to look like this week or next week. I'm not really concerned about that. What I am concerned about is where is the ultimate opportunity for Celsius? What are they doing differently than the competition? Where are there opportunities to grow in places like international markets? Are they going to be increasing their shelf space? Is revenue and net income going to grow? Are margins remaining high? These are the fundamental questions that are going to drive Celsius's shares long term. But short term, it is going to be things like scanner data, which is just market analysis data, particularly coming from Nielsen, that is trying to figure out what is the market share of companies in the energy drink market on a week-to-week basis. And that is the reason that the stock is down so much over the last couple of weeks. So I want to go through what we might know about the company's performance in the second quarter, what's driving the stock, and then how I'm thinking about shares today at $57 as I'm recording, as opposed to where they were when they were near $100 per share. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So first of all, let's look at the volatility that we've seen in Celsius. This is just the past 1 year on Celsius for Celsius from Google Finance, and you can see that shares have gone from about $48 per share a year ago to $57, but we've had massive volatility over that period of time. Now, this is a company that I started covering about 6 months ago, a little bit more, and I was buying shares in this range. I know I did a number of videos as shares went up to $80, $90 per share, and the discomfort in that level is always that it was an extremely expensive stock, trading for 100 times earnings. Well, things have come down obviously since then. The current numbers, according to FinChat, price to earnings multiple is 62. On a forward basis, the pricing earnings multiple is 51. So still very expensive for any company, but this is also a company that over the last 5 years has grown at a 91% compound annual growth rate. And over the next 2 years, analysts are expecting almost 30% annual growth. So where are the blips in this? The biggest thing comes from scanner data that ultimately comes from Nielsen. Now, this is reported from Morgan Stanley through TipRanks. But what they're saying is that market share has fallen to 9.7% compared to 10.7% in early May. This is one reading that when it was rising, Celsius was taking market share. It seemed to be very bullish for the stock. That was what we were seeing earlier in 2024. Now that number has reversed later in the year, basically late in the second quarter. What these readings don't say is that despite the fact that they're thinking that market share has been lost over the last couple of months, and this seems like a pretty big market share loss. So I think we have to concern ourselves with how reliable is this data on a week-to-week basis. It just can't be 100% reliable. So probably got a little bit too high earlier in the year, probably a little bit too low, but we'll see what things look like when second quarter results come out. But the other thing that it doesn't highlight is that Celsius has gained market share and is anticipated to grow sales year over year. So market share may be down over the last 8 to 12 weeks, but revenue will be up in the second quarter. At least that's what this data is indicating. So we need to put these numbers into a little bit of context. And I also think we need to bring in the inventory question, because Pepsi, who is their distribution partner, particularly in the US, has really been a big question for Celsius. What are they going to do with their inventory? Because when Celsius sells product to Pepsi, they book a sale. But Pepsi ultimately sells to a retailer who then sells to the ultimate end customer. So there's a few pieces in the ecosystem, and both of those players, the retailer and Pepsi, are holding inventory. When they're building inventory, so the number of stores holding Celsius products is expanding, sales are going to explode for Celsius. Now we're at a little bit more of a steady state. Earlier this year, we saw the locations of a lot of Celsius products change in a lot of big box retailers, went into a lot of other retail locations. So that inventory build out has likely changed from a retail standpoint. Now, Pepsi is changing how much inventory they're holding from their standpoint. So there's going to be some volatility potentially on the downside for the way that Celsius sees things. But what's ultimately the most important is how much end customers are buying their product. And that's what we'll find out a little bit more about when second quarter results are announced. So let's go through the numbers that we know today and a couple of things to keep an eye on when results are released.
Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now.
The first thing to obviously keep an eye on is total revenue. You want to see that revenue continue to grow, and then gross profit. I'm just going to put gross profit margin here. And you can see that those margins have been increasing steadily since the middle of 2022. That's been hugely helped by that partnership with Pepsi. But a 50% margin, is that going to be sustainable? Well, we don't quite know yet, and we don't quite know what the balance between margins and sales are going to be. One of the things that I saw making the rounds on social media recently was discounts that have been going on in Celsius products, particularly at Costco. So not all that surprising. Costco is just putting out pallets and pallets of Celsius product, and they were not discounted 50% from anything that I saw. It was a 25% discount. It was still a relatively high price point, about $18 for a 12 pack. So that's going to be likely a pretty good margin for Celsius, and Costco can be a place that does a ton of volume. We'll see exactly what that balance is for Celsius over the last few months, but look for management to discuss not only what their revenue and sales are and their margins, but also what the end customer is going to be, because we have heard comments from them that Pepsi is likely going to reduce their inventory again in the second quarter. So if revenue is still up, but maybe sales growth slows to 15 or 20%, that may not be all that bad if it coincides with your distributors reducing their inventory, because that means that the end market demand is actually higher than the sales growth that we're going to see at Celsius. There are a couple of other things to keep in mind though, and one is international sales. This is a chart that shows all of the other international, so non-North American markets. Now, Canada is likely an area where Celsius is going to be able to grow a little bit in 2024. But these are essentially untapped markets. I mean, European revenue, $49 million for the last 12 months. That is tiny compared to $1.4 billion in North America. So there's a ton of growth opportunities for Celsius to move into new markets. So in certain places like the US, maybe even in Canada, we're going to see more of that maturing. It's going to be maybe slow and steady growth, 10, 20% growth. There's going to be inventory fluctuations. So numbers are going to be going up, but they're not going to be going up in a straight line. But where there could potentially be significant growth is some of these new markets that Celsius has announced in 2024. They have some distribution partners who are outside of the Pepsi ecosystem. That could potentially be good to have partners that aren't necessarily quite the same competitors that Pepsi is. But those markets have a ton of opportunity for growth. So when you're paying this kind of multiple for a company like Celsius, it's important to keep an eye on what the growth opportunities are. Yes, growth in the US is likely to slow from that 100% rate that we've seen over the last few years. But that doesn't mean that we're not going to see growth in Europe, in Asia, and the other parts of the world. So that's something to keep in mind when you're looking at the multiple that shares are trading for right now. The other thing that I'm curious to hear about is other retail locations. We've heard a lot about Celsius making its way into smaller restaurant locations, into more convenience stores. I live in the upper Midwest, and Celsius was basically not available here 2 years ago, started to make its way into big box retailers like Target, and now suddenly it seems to be everywhere. So that should grow the end market sales for Celsius. But again, the growth is not going to be in a straight line. So we'll see exactly how that plays out for the company. But don't take this scanner data that is trying to figure out what market share is week to week as gospel for what a company is going to do long term. It depends on what your time frame is in your investment. I am not buying Celsius today in hopes that shares are going to be up next week. If that's the game that you're playing, we're simply playing different games and we're having a different conversation. I think Celsius can be the kind of product that's going to replace sodas, that's going to replace other energy drinks, that market share gain is going to be a gain over a long period of time, not only in the US, but also in international markets. And so that's what I'm looking for long term. So I'm much more interested in that long-term growth trajectory and Celsius taking more shelf space in the places that I'm shopping. If those long-term trends continue, then the stock will continue to do well. But there will be blips along the way. And some of these inventory changes that we need to keep in mind in 2024, that will be one of the blips. We may see some market share changes, but we'll look for management to give it a little bit more clarity on exactly what's going on and compare that to what other companies are saying as well. What is Monster saying? What is Pepsi saying? Because one of the things that we're hearing in a lot of these consumer related businesses is growth just isn't what it was a year ago. So consumers may be pulling back a little bit. That puts a little bit of pricing pressure on product companies, maybe takes back a little bit of their growth. And the natural reaction for stocks is to pull back a little bit because investors don't want to pay too much for growth that doesn't end up materializing. So all of these things are what needs to go into the calculus behind Celsius. I'm not selling shares, but also my cost basis is right around $50 per share. So I've tried to avoid paying too much for the stock, but that's also hard to determine exactly what that is for a company that still at today's price is trading for 60 times earnings. But let me know what you think about Celsius and the recent data, what your time frame is in the comments section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.